Since the war in West Asia began, Indian markets have seen sharp swings. Between 27 February and 27 March, the Sensex fell 9.4%, the Nifty 50 dropped 9.3%. Rising crude oil prices and sustained foreign investor outflows kept sentiment weak through April. Then came a brief shift. A 2-week US-Iran ceasefire triggered a sharp rally. On Wednesday, markets saw their best single-day gain since March 2021. But the relief was short-lived. Just a day later, Iran accused the US of violating the ceasefire. Markets reversed and those gains were erased. So what is really driving markets right now? And how should investors interpret these sharp reactions? Let's break it down in this episode of Market Special. Sameer Arora of Helios Capital believes markets are signaling that the worst phase of the conflict may be behind us. According to him, the March sell-off was driven more by fear than fundamentals. Several sectors corrected over 15% and are now seeing a recovery. He views the recent rally as a natural rebound, not an excessive move. Importantly, he argues that the underlying economy remains resilient. Auto companies continue to report strong performance. Bank credit growth is improving. Consumer demand has held up. Global brokerages, however, are more measured. Rabobank believes the conflict is far from over, pointing to renewed disruptions around the Strait of Hormuz. Bernstein says this may not be the end of the conflict, but it could be the end of the crazy escalation phase. It expects a short-term rebound but maintains a measured outlook with a Nifty target of 26,000. De Beer Group says markets are reacting to a pause, not a resolution. Downside risks remain. S&P Global Energy adds that even if tensions ease, normalization of oil flows and trade could take months. Now that brings us to the most critical factor, crude oil. Prices briefly softened on ceasefire news, but quickly rebounded to the $97 to $100 range. Analysts say the key level to watch is $80 per barrel. Sustained prices above that level could push up inflation, compress corporate margins, and weaken overall sentiment. Now, if crude does not ease meaningfully, the recent optimism in markets may prove premature. So, is the worst over? Possibly, but not definitively. Arora says markets are not behaving as if the worst lies ahead. He's not expecting a sharp rally, but sees the potential for around 15% returns over the next 12 months, following the 7 to 8% gains seen in April. For now, uncertainty remains. The conflict is unresolved, oil prices are volatile, and the full economic impact on earnings, inflation, and consumption may only become visible over the next 1 or 2 quarters. In the near term, market direction will depend largely on developments in West Asia and where crude oil prices settle. That was it for today's episode. For more such deep dives into markets and the economy, follow Business Standard.